Perpetuals and Spot BTC AMA. Today we've put together a recording of how you can build delta neutral portfolios and take advantage of the differentials of pricing between these contracts. We'll be having a look at how you build those portfolios, and then at the end of the video we'll be going back to have a look at how this has performed since last night when we recorded it. We've had one of the most volatile days in crypto certainly this year, probably in the last 6 months, unfolding today. So that'll be a really interesting demonstration of how these portfolios perform in situations of real volatility. So first of all, I'm going to go over to the video. Once that's finished, we'll come back and have a look at it again, and then there'll be some time for questions at the end. We're going to be looking at spot, perpetuals, and dated futures on Bitcoin this evening, and having a look at how we can build some delta neutral portfolios using those contracts to exploit the pricing differences between them. All three of these contracts track the price of Bitcoin, but there are some small differences between how they work in the details that will mean that we can build these interesting portfolios and exploit those price differentials. I'm just going to share my screen with you now. So as I say, we've got these three contracts in the table. We've got Bitcoin Spot, Bitcoin Perpetuals, and Bitcoin Futures. If we want to take exposure to the Bitcoin price, the easiest thing we can do is buy Bitcoin Spot. This has the advantage that Bitcoin Spot never expires. It just sits there in your portfolio, and it tracks the price of Bitcoin perfectly because that's what it is. There are no funding payments into or out of your portfolio, so it's very easy to manage in that sense. But there are some disadvantages as well. Today, Bitcoin is trading at about $38,000 or $39,000. So if you wanted to take exposure to one Bitcoin through Spot, you need to find $39,000 of capital to take that position with. So it's quite capital intensive. What's more, if you wanted to take a short position, so you thought Bitcoin was going to go down in price, you would need to take a short position. And that's very difficult to do with Spot because you can't sell Spot that you don't already own. So advantages of Spot are simplicity, but disadvantages are that we can't take leverage and we can't go short. So that's really where derivatives come in. Now, the first derivative actually I'll talk about will be the futures contract, because historically that was the one that came first. A futures contract is an agreement to buy or to sell some amount of Bitcoin at a date in the future, normally 3 or 6 months away. So what are the advantages of this? Well, because we're agreeing to make the trade in the future and not today, it means that we don't need to have all of the cash available up front to make that trade. So this means that we can trade with leverage. You can put down a smaller amount of capital and still take a larger exposure. So for example, if we wanted to trade one Bitcoin at 10 times leverage, you would only need to put down $3,900 instead of $39,000 as with Spot to take that same position. This means that it's much easier to take large positions, but of course your risks are also multiplied up proportionally. So it's something you need to be very careful if you're going to do. The other advantage of futures is that you can agree to buy or to sell those futures. So you can easily take a short position as well as a long position using a futures contract. What are the disadvantages, though, of futures? Well, the first thing is that we've already said it's got an expiry date, the date that we've agreed to make that transaction on. So if you want to keep your futures contract open after that, you're going to need to manage your portfolio somehow. There are several ways to do this. What people often do is they will close out their futures position and open a new futures position in a longer dated contract, which we call rolling the futures contract. But clearly this is annoying. There are costs involved, and there's a little bit of execution risk as well. So that's one downside of trading futures. The other thing is that although they must converge to the price of Spot when the expiry date arrives, because if they didn't, there would be people taking advantage of that pricing differential, between now and then, they don't have to track Spot closely. So you often see futures trading at quite a large premium to the Bitcoin Spot price between now and expiry. And that's actually one of the pricing differentials we'll discuss how to exploit in a little while. So futures, advantages, you can take leverage and you can go short. But disadvantages are that it doesn't track Bitcoin Spot too closely necessarily, and it has an expiry that we have to manage somehow. So this brings us to the third contract, the perpetual swap or perpetual futures contract. This is a really, really interesting contract. Just like futures, we can easily go short and we can easily trade with leverage. But unlike a futures contract, it doesn't ever expire. So we can hold this in our portfolio and we never have to worry about an expiry date. It also tends to track Bitcoin Spot very, very closely. And the way it achieves this is through a funding mechanism. So what happens is that if you're holding a futures contract, a perpetual contract, and you're holding spot, you'll see that the price isn't exactly the same, but it's close. Now, on most exchanges, they will track the difference in price between those two contracts. And every 8 hours, usually 8 hours, sometimes it's a different time period, but every, let's say 8 hours for now, there will be a funding payment where if the perpetuals price is above the spot price, people who are long the perpetuals contract have to make a payment to people who are short the perpetuals contract. So this, of course, encourages them to reduce their position size, which in turn pushes the perpetuals price down. On the other hand, if it's trading below the spot price, the people who are short the contract make a funding payment to the people who are long the contract. So this, of course, tends to push the price back up. And the net effect of this is that perpetuals track spot really, really closely. So advantages of the perpetuals contract are leverage, and you can go short. And additionally, it tracks the spot price really closely. The only downside, although again, we'll be having a look in a little while about how we can take advantage of this, is that we have these funding payments. So potentially we're having to pay to keep our position open if we're on the wrong side of that payment. And the other thing is, of course, that there's no certainty in what that payment will be. So we don't actually know until we reach the funding payment how much we're going to be having to pay or receive. And every 8 hours that will change again. So there's a little bit of uncertainty around these funding payments, which could be a problem. So that's it. These are the 3 contracts that we're going to be having a look at. All 3 of them trade on Equinex. So I'm going to show some practical examples of what these trades look like in a little while. The first delta neutral trade that we're going to think about is how you can trade the spot against the dated futures contract to take advantage of the premium that the futures contract is trading at. So I'm just going to change page on my presentation. This trade is called the cash and carry trade. We've said that when we reach expiry, as shown on this graph, the spot price and the futures price must converge to the same price. But before expiry, they're not guaranteed to be the same. So what if the futures price is trading above the spot price? In this case, we can do this really simple cash and carry trade where we buy 1 unit of spot and sell 1 unit of future. Now, why would we do this? This is one of the easiest ways to generate a delta neutral portfolio. And the point is that if we've bought the spot and sold the future, the P&L coming from each of those 2 positions will offset each other. So if the spot price goes up after that, we will make money on our spot leg, but because we're short the future and the future will also go up, we'll lose money on the futures leg. Conversely, if the spot price goes down, we'll lose money on our spot leg because our spot is now worth less, but we'll make money on that short futures position. And because futures prices track spot prices quite closely, those 2 numbers will tend to cancel each other out really, really well. So it won't be 100% delta neutral between now and expiry, but the net profit and loss on the portfolio will actually be very small. However, because we've said the futures price is above the spot price before expiry, but converges to the spot price at expiry, this means that by doing this trade, we've locked in that premium over the lifetime of the trade as long as we hold those 2 positions to expiry. So the spot is worth less than the futures price now. We've bought the spot, let's say, for 39,000, and we've sold the futures contract for, let's say, 41,000. We know that they both expire to the same price. We don't know, and actually we don't care what that price is. If they both expire to 80,000, we wouldn't mind because we're long the spot and short the future. Equally, if they expire to 20,000, again, we're delta neutral, so we're still neutral to that price. The only thing that matters is that the $2,000 differential between the spot and the futures price has gone away. And because we were short the future and long the spot, that's the profit for this trade. Now, frequently in crypto, you'll see that the yields from this trade are really, really high. So if you imagine that happened over 3 months, you made $2,000 on a $40,000 Bitcoin contract, that's 5%, and 5% over 3 months would be 20% annualized, which is an incredibly healthy yield by traditional finance terms. But some downsides of this trade are that it's difficult to leverage. So because we've used spot in this portfolio, and we've said that spot is difficult to leverage, we're not able to take that yield higher using leverage. We just have to put our $40,000 in to buy the spot. The futures contract can trade on leverage, so we don't need to put so much margin down for the futures contract. In many exchanges, on Equinex, for example, you can actually use the spot to margin your futures contract, so you probably don't actually need any extra capital. but it's hard to lift that yield beyond just the futures premium. So we can lock in a strong yield, but we can't do much better than that. Now, we're going to have a look at what this trade would look like on Equinix right now. And I've got the Equinix product basis bot just here. So this is a public tool. Anyone can use it. If you join the Equinix Dated Futures Basis chat on Telegram, you'll have access to this as well. And we've got several commands we can use. I'm going to use the product basis command for Equinix. And then this will calculate for me the current premium that the perpetuals and the futures contracts are trading at above spot. So you can see it's already generated a table for me just down here. It takes a little while to get your head around the first time you look at it, but let's just look at the first column. This is telling us that this is how the spot and the perpetual and the March and the June contract are trading at versus spot. You can see actually we're in an interesting position today. Usually in crypto, you see the perpetual contract and the futures contracts trading above spot. But actually here you can see our perpetual contract is trading $8 below spot. Our March future is trading $597 below spot. And our June future is trading $620 below spot. So we call this situation backwardation, which is when the futures prices are trading below the spot prices. And actually this means that the cash and carry trade, which is usually so appealing, won't be very appealing to us today. And the reason for that is that if we buy the spot for 39,000 and we sell the futures contract for 39,000 minus $600, all we're going to do is lock in a $600 loss. So actually, usually this is a great trade. Today, we'd really like to do the opposite trade. We really like to sell the spot and buy the futures contract. But as I've said, spot by itself, we can't go short very easily. So that's not a very easy trade to do. On the other hand, if you're already holding spot, what it does make a lot of sense to do would actually be to sell your spot contract now. So sell your one Bitcoin for 39,000, buy the futures contract for 38,400 for March, and then wait until expiry. And by the time we reach expiry, your futures contract will settle. You'll get your spot back, and you'll find that you've got an extra $600 sitting in the account coming from the discount that you bought that futures contract at. So that's the cash and carry trade. I won't actually put that trade on today because, as I say, it would lock in a loss. But this is a really great opportunity. Keep an eye on the product basis calculator, and if you see it, it's a great trade to think about doing, and it's the easiest delta neutral trade that we can do. However, I've said that we can't leverage this trade. Trading opportunities like this are good in that they give you if they give you a strong yield, but often what traders will want to do is find an opportunity, find a small mispricing, and then trade it at very high leverage to multiply up their returns. Of course, whenever you use leverage, you're multiplying up your risk as well as your potential reward. So you do have to be really careful. But we're going to have a think now about how we might build some delta neutral portfolios that we can use leverage on. And in order to do that, we need to trade futures and perpetuals against one another. So we need to do a similar thing to what we did before, go long one and short another contract. But this time we want them both to be derivatives rather than spot. So we're taking the spot leg away, which will allow us to leverage on both sides. Now, we just saw from Telegram that we've got this perpetuals contract, which is trading a bit below spot. We've got two futures contracts, which are trading quite a long way below spot. And we discussed with perpetuals that there is this funding mechanism every 8 hours. So I've also got the historical funding payments that were paid by Equinix, which I'm just going to flip over to now. So this table shows us how much you would have received every 8 hours if you are long one Bitcoin contract on the perpetual futures. So you can see this is all in UD, by the way. So this is midday today Hong Kong time, or 4 a.m. UTC. If you'd been long one Bitcoin of perpetual future, you'd have received $4.78. Last night, 8 p.m. UTC and 4 a.m. Hong Kong time, you'd have received $5.20. The previous one was $8.16. And you can see that although the numbers are quite variable, they go up and down, recently they've been very strongly positive. So that means that if you're long one perpetual futures contract, you would have been receiving a stream of payments every 8 hours. So that's really interesting. We'd love to be able to find a way to receive this income stream, but not be exposed to the volatility risk of Bitcoin, because of course we've said that these perpetual futures contracts track the spot price very closely. How can we do that? Well, here's the trade. What we can do is we can go long the perpetual futures contract and go short a dated futures contract, which also tracks the price of Bitcoin as our hedge. Now, the prices in this table are a little bit outdated, and we'll go back to the Telegram to check them out in a moment. But I put these in a couple of days ago. And the idea here is that maybe we go long the perpetual contract and we go short, probably in this case, the June futures contract, because the price here is a little bit above the perpetual. So we know that over the lifetime of that futures contract, it will have to come down towards the spot price. At the same time, we're receiving payments from the perpetuals contract. So we're receiving on the long perpetual leg. We are, between now and expiry, also going to gain on the futures leg that converges towards spot. So this seems like a really, really appealing portfolio trade that we could put on. And in just a moment, I'll do exactly that. Before we do that, though, we should have a think about some of the risks. The first risk is that, as I say, although I showed you this historical basis, which I'll pop back to now, although we can see that this has been positive in the very recent past, if I go back far enough, we'll see that it was actually very, very positive about a week and a half ago. But if we go back far enough, we'll see that there have historically been some negative payments, and some of the time they can be quite large. So here we go. We're 5 pages back now, which is probably about 3 or 4 weeks ago. We can see that here there were some negative payments as well, and historically there were periods when it was paying out negatively for a prolonged period. So if we open this trade now, and then that starts to happen, all of a sudden we'll be making payments on our petrol leg instead of receiving. So what looked like a great deal wouldn't be such a great deal anymore. And then we'd have a choice. We could either hold and hope that the payments came back positive again, or we'd have to close our portfolio. And this leads to the second risk. The perpetuals contract tracks spot very closely, but the futures contract doesn't have to. So the futures contract, we know it will have to come down, in this case, from 40,800 to 40,700, or at least to whatever the spot price is between now and expiry. But in between, it could go up a lot. So if we suddenly had to come out of this trade, let's say in 3 weeks' time, because we don't want to be paying these payments on the perpetual anymore, we'd now be really exposed to whatever's happened to the futures price between now and then. So if in the meantime the futures price had actually gone up, we'd end up having to close out our futures position at a loss, which might well be more than all of those payments we'd received on the perpetual. So there's a little bit of judgment involved here, and it's not a risk-free trade. All we can say about it is that it's relatively well hedged to the price of Bitcoin, and at the moment it looks very appealing in terms of those basis payments that we're going to receive. So now I'm going to pop over to Equinix Exchange and show you what it would look like to put that trade on, and to show you how that we can think about the leverage that we're taking. Just before that, though, I'm going to have a look at the bot again to get an updated set of prices to do some planning about which of the futures contracts I will use as my hedge. Shouldn't have moved much in the 5 minutes between now and when we last looked at them. So we can see actually now both the March and the June futures contract are trading well below spot and the perpetual contract. So it's not so obvious whether I should use March or June, but actually I'm still going to use June. And the reason for that is that I know that March expires on the 25th of March, which is a little over a month away, whereas June expires 4 months away. So I know that this $570 will have to disappear. Will have to disappear in just 1 month, which means these futures contracts will have to come up quite quickly, and that's not something I want if I'm short. Whereas this June contract has much longer to come back up from this minus $611. So I'm going to go long the perpetual and short the June contract. Let me just pop over to my exchange account, and here we are. So we can see I'm looking at the Bitcoin perpetual futures contract at the moment. We can see that it's trading at $38,900, and there's an expectation that I will receive $4.78 of the next funding payment. Now, this is not locked in until we reach that 8-hour mark, which will be 8 o'clock Hong Kong time. But we're getting fairly sure now. Most of this calculation is based on 6 hours and 40 minutes of funding, so that's a fairly solid number. I'm just going to go to the dated futures contract for June as well to check that the pricing that we got from the basis bot was about correct. And we can see that sure enough, it's trading at about a $600 discount. So time to put on the trade. I want to go long the perpetuals contract and I want to go short the futures contract. One last thing we should think about is execution risk. I need to buy one contract and I need to sell another contract to hedge it. And really, I want to do these two things as close together in time as possible. If I came in and bought one contract now and then didn't do the other side of the trade for another 5 minutes, there's a real risk that after I bought the first contract, the price could fall dramatically, and it's Bitcoin, so it is a volatile asset. If that happens, I've got the long position, which would lose a lot of value, but I don't yet have the short position to hedge it. So I'm really exposed to downward movements in price. On the other hand, though, if I'm happy to use limit orders instead of aggressive market orders, it's much cheaper to trade. So there's a balance here that I have to strike. If I want to go in immediately and be very well hedged, I need to use aggressive orders, which are more costly. Whereas if I'm happy to take some risk on the execution, so let there be some time delay in between taking the two sides of the trade, then I can use limit orders instead, which are cheaper. For the demonstration today, I'm going to use aggressive orders so that you can see me going into the position very quickly. But there's still some execution risk because I'm going to have to, as I'm trading on screen, I have to make the trade in the perpetuals contract and then very quickly flip over to the dated futures page for June, which involves a couple of clicks, and then fill in my order form and take the other side of the trade there. So if in the 10 or 15 seconds that it takes me to do that, there's a dramatic downwards move in Bitcoin, I'll suffer a lot. Of course, there's also upside exposure. If it jumps while I'm making that trade, I do very well. But generally, we think of downside risk as being a lot more dangerous than upside risk. So I'd really rather that the time difference between those two trades is as small as possible. Anyway, we'll do some sizing as well. I've got about $1,000 of capital in this account. I could trade with up to about 100 times leverage. So I could take $100,000 of position, which is 2.5 Bitcoin of position. But clearly, that's not very prudent, even though this is quite a well-hedged portfolio. So probably what I'll do is I'll take about 0.1 Bitcoin on either side, and then we'll look at how the position is looking after that. So I want to buy 0.1 Bitcoin using a market order of the perpetual. As soon as I click buy, you'll see it flashing on the screen. So I'll be hitting the ask price, and you'll see a new trade appearing in the trade history. And then I'm going to jump over to the futures very quickly and take the short side of the trade. So here goes, buy, boom. I can see it's appeared in the trade history. Now I'm going to the futures contract fast as possible, and I'm going to go short. Last check. Oh, interestingly, the book is very thin at the moment, so I'm going to be a little bit careful. I'm going to do this in 2 strikes. I'm going to hit the top of the book for 0.06. Ah, dear. So this account is not yet enabled for trading dated futures. So I'm very quickly going to go to account management and enable that. And I've gone to the wrong place. And here we can see the risk of these two-sided trades, because if there's a big movement now, I'm going to suffer. So that was in my this account here. I need to turn negative balances on, confirm, done. Dear. No, I can't remember which oh, it was in there. Great, so I've got my long perpetual contract. Now I'm going to go short the dated futures contract. A little bit of panic there. And as I say, I will go 0.06 first, and I'll wait till I see that on the book. Sell. And I still need to get 0.04 of short again, so I'll go 0.04 now. Look with that. And now I should have my hedged portfolio. So let's have a look at the position that we're in. You can see I've got a long leg and a short leg. The long leg is the perpetual 0.1 Bitcoin, which should be set to receive about 40 cents. Sorry, so 1 Bitcoin of perpetual would receive $4 of funding. This will receive 40 cents of funding in a couple of hours' time, and then receive another payment every 8 hours while that basis stays positive. And we can see on the short side, I've got short the June dated future. In terms of absolute size, they're both about $3,000 of exposure. So my gross exposure now is about $6,000. I've said I've got a little bit under $1,000 of capital in here. So that corresponds, I can see over in my account leverage panel, to 8.47 times leverage. Now, it is worth mentioning that although typically we would think of an 8 times leveraged position as being quite risky, this is actually a very well hedged position. So if Bitcoin does move dramatically, one side of this trade will gain and one side of this will lose. So the portfolio value will not actually change so much. So with these hedged portfolios, leverage is a tricky number to think about. We still need to be careful when we're trading with leverage, of course, but it's not quite as dangerous as just taking an outright leveraged position. So this is all good. 40 cents, I mean, it's an okay payment, but maybe I want to take a little bit more risk. So why don't we size this up just a little bit more? I'm still on the perpetual, so I will buy myself 0.1 BTC more of perpetual. And I'm going to now sell some of the June contract. Again, I can see that the biggest order on the front of the book is only 0.06 Bitcoin. So if I trade more than that in one go, I'll end up getting half of my fill done at a much less good price, which is why I'm doing this in 2 steps. So into that 0.06 and then another 0.04 once I see the book getting filled up again. And now we should be good. So there you go. This is the essence of how to put on a delta neutral position. What have we thought about today in summary? First of all, I'm just going to pop back to the slideshow now. First of all, we had a thought about what we wanted to trade against what. So we scouted out the prices of the perpetuals versus the futures and looked for an interesting opportunity. We found that the perpetuals were paying a positive basis. And although the futures are trading at a discount to spot, which means that if we hold those to maturity, we do expect a loss on the futures leg. We're hoping that will be more than made up for from the positive payments on the perpetuals leg coming from the basis payments. We're trading at leverage. So although I've only got $1,000 in that account, we've seen that I've already traded $12,000 of gross position. So I'm receiving much more basis than I would receive if I just went long $1,000 worth of that perpetuals contract. We can see here how we can build delta neutral portfolios, which are relatively hedged against the price of Bitcoin movements, but still take advantages of those differentials in the pricing. Finally, I'm just going to pop back to the portfolio. We'll just have a look at how much it costs to enter those positions because we used aggressive market orders, which are, as I said, the expensive way to do it. We can see that the fee over here was about just over $2 per leg, and I did two trades, and each of those legs were, so this was for 0.1, and I traded 0.2 on either side. So we paid about $9 to go into those positions. Now we've said that we're expecting this to receive about just under $1, so $4.80 or something for 1 Bitcoin means about 90 cents for my position, my 0.2 position here. So it'll take me about 10 payments to cover the cost of the trade, which is about 3 days. So I'm hoping that this trade doesn't, the basis payment stays positive and hopefully increases for at least 3 days to cover the cost of the trade. Anything beyond that starts to be profitable. Although, of course, I will have to come out of the trades on the other side. Maybe because I won't be in such a rush, I will look at coming out of one side of this using a passive limit order, though, which would reduce the price of the trade to zero. These passive limit orders are not charged fees on Equinix. So there are some other factors to consider in terms of execution and execution risk, but that's the topic for another AMA. Okay, that is my presentation all done with. I'll just pop back to the first page now. We're going to go over to the AMA section of the talk now. So if you've got any questions that you'd like to ask, please fire them into the chat, and we will be taking a selection of them, which I'll be having a go at answering. So thanks very much for listening to me so far, and please send us your questions. Apologies, I was on mute. So just before we do questions, I'm going to share my screen with you, and we're going to have a look at how that trade performed. We've had one of the most volatile days that I can remember off the back of some very serious macroeconomic news. So let's have a look at what has happened to that trade that we put on yesterday. First of all, you can see I've still got the same size on, long 0.2 of the perp and short 0.2 of the future. The unrealized P&L on the perp leg is minus $750 because, of course, Bitcoin has come off by about 10% today. Offsetting that is $760 on the futures leg. So you can see that that's almost perfectly balanced, and I'm absolutely nowhere near being in any danger, given that I've got almost $1,000 of margin in this account. Let's also have a look at the basis payments that we received. So you can these top three payments were the payments received from the perp on this occasion. And you can see that actually in sum they're about $30. So this yield trade is already working pretty well. I'm already receiving basis payments, which have more than covered the cost of getting into the trade, and they comfortably cover the unrealized loss on those two positions summed together. So this really goes back to what we were saying about the level of hedging on these delta neutral portfolios. Even though we've seen a very, very volatile day, at a portfolio level, these two trades are still very comfortably safe. And for the moment, they're nowhere near being in any danger of needing to be actively managed. Great. Following that, I'm going to take questions. So please do send any more questions. We've got a great selection already, which I'm going to start working through, but I'd love to get more. Just starting with Kieran's question, how far into the future does the dated futures contract go? That's a great question, and it is platform specific. Typically, they will be quarterly, and they'll settle on the same quarterly dates that futures and traditional finance settle. So, for example, the two contracts that are listed on Equinex right now settle on March the 25th and June the 24th. We're also going to list a September future a week and a bit before the March future expires, so that people can roll onto that if they want to as well. So usually it's about 3 to 6 months, although on some platforms you might be able to find longer dated futures as well. Certainly you don't see the 2-3 year futures that you tend to see in traditional finance on Bitcoin just yet. Things go a bit faster in Bitcoin. So 3 months in Bitcoin kind of seems like a year in traditional finance. So maybe that's why. To Andy, can you see the historical premium or discount futures have traded at versus spot anywhere? Well, we do have this basis payment page that we were looking at before, and I'll just pop over to it again now. So if you go onto the perpetuals page and you follow the link next to the basis payment, you'll be able to see the historic payments that have been made on our perpetual futures, both Ethereum and Bitcoin. In terms of the historical data on dated futures, well, we've actually only just listed them on Equinex in the last month. So we don't have a huge amount of historical data, but we will be making it available to people as that data set grows. We haven't got a systematic way of doing that just yet, except through our public APIs, but we're actively investigating how we can do that in a convenient way. Next question is from Satoshi Kakashi. Is there a liquidation risk still when you perform this delta neutral trade? This is a really important question. And the answer is yes, there is still a risk. So I'm just going to pop back to the position that I've got on now. And you can see that if you sum up the unrealized P&L of those two positions, it's just a bit under minus $20. Now, it could happen that the futures price shoots up and the perp price doesn't shoot up. And in this case, because I'm short the future, I would be losing money on that leg, and I wouldn't be making offsetting money on the perp. And equally, I could see that the perpetual falls a long way and the future doesn't follow it. We've seen historically that they tend to track each other really well, but there's no guarantee that that will continue to be the case. And importantly, if they separate by enough, so in this case, I've got about $940 in the account. I can see over here that the margin liquidation trigger is $55. So that means that if there were enough unrealized loss on these two positions that I went from $940 down to $55 of available margin, which would take not quite $900 of unrealized loss, then I would be at risk of liquidation. So on positions of this size, it seems really unlikely that I'll be able to have a net unrealized loss of $900, but it is not impossible. And so even with hedged delta neutral trades, you do still need to manage your position, particularly in volatile markets, because that's when you tend to see these funny moves where things don't move in the sync that don't move in sync with one another as we're used to. Kieran K, can we send the link to Telegram? And I see that my colleague has sent that to you already, so please do go on and have a play with the basis spot. It's quite fun. There's some great opportunities that you can spot from time to time there. How can one calculate open interest on Equinex derivatives? We don't currently make that number public. We are looking at how we can incorporate that into our API and into our GUI, but at the moment it's not available, I'm afraid. If you reach out to customer support, they can provide you these numbers on an ad hoc basis, but that will be available soon through the GUI or the API. Andy Marshall, is there a direct relationship between spot futures basis and the spot borrow market rates? There absolutely is, yeah. When we think about these trades, so I'm going to start by let's go back to that cash and carry trade that we talked about right at the beginning in the video. So this is on page 2. We said the cash and carry trade is where you buy spot and short the futures price, and then at the maturity of the contract, your short future means that you have to give that Bitcoin to somebody else at some prearranged price. So you buy some Bitcoin at the beginning, for which you pay dollars. At the end of this portfolio lifetime, you sell that Bitcoin to somebody else, and you receive back more dollars than you put in. If you think about it, that really looks a lot like a collateralized borrow or lend operation. It might look very similar to a repo for those of you who are familiar with that. So implicitly, really what we are doing here is lending dollars. And in fact, it doesn't really matter whether you've done this by buying Bitcoin and selling the Bitcoin future, or buying Ethereum and selling the Ethereum future, or any other asset. Effectively, what you've done is lent USDC to somebody else at some quite high yield. So certainly, yeah, if the borrow rate for USDC is high in crypto, and it tends to be high, but it's also very volatile. So at the moment, actually, it's negative within crypto, but it often can be very, very high. Then we expect to see that futures price trading at a really significant premium. Now, on the opposite end, I'm going to go back to the Telegram basis spot. Oh, that's not very promising. Okay, we've reloaded the basis spot. Let me pull up the product basis. So we've said that we're actually seeing the opposite thing here today. We're seeing that futures are trading at a discount to spot. And we've said that actually we can perform the opposite operation now. If you're holding Bitcoin and you're happy to sell that Bitcoin and buy the futures contract, you're selling the Bitcoin now for the spot price. You're receiving the Bitcoin back at a $530 discount in March. That now looks a lot like a collateralized Bitcoin lend operation. So sure enough, if Bitcoin lend rates are high, we expect to see a discount. If dollar lend rates are high, we expect to see a premium. And that's exactly what causes these futures prices to differ from spot prices. This is actually very similar to traditional finance futures pricing. There is a great email I know that's being planned by our Economics editor, which will be coming out early next week. So do sign up to Economics if you're not already signed up, and we'll be investigating these dynamics in a little bit more detail there. Can I explain a bit more what factors could affect the basis payment? So the basis payment on Equinex is determined entirely by the difference between the spot and the perpetual's price. So we can see that at the moment, the perpetual trading at a slight discount to spot. And what that means is that the basis payment is likely to be positive. We take the TWAP, which is an average over an 8-hour period of this difference between the spot and the perpetual price, and then that determines how much will get paid at the end of the 8-hour period. And once again, if the perp is trading below spot, then it means that the people who are long will receive a payment from the people who are short. And if the perpetual is trading above spot, then the people who are short will receive a payment from the people who are long. So currently we're in a backwardation state. That tends to mean that people who are long are getting paid because, of course, with the current price action, people are quite keen to be short on the whole. Whereas when you see pumping markets, you'll often see the reverse, where people who are long have to pay the people who are short in order to hold those long positions. How do I decide to exit a trade? Are there some specific indicators to watch or to be mindful as signals? Yeah, this is a really, really interesting question, and there is so much depth to think about here. We've explored a few different strategies that we could have adopted. So we've looked at spot versus futures, and then we thought about perpetual versus futures. And of course, you can also think about futures versus futures, which is something we call a calendar spread. In terms of coming out of the trade, there are different ways that you can think about it. So we saw that my trade is currently paying quite a nice stream of basis payments. There is a slight realized loss on the pair of positions, but I'm still receiving these positive payments every 8 hours. I'm not very motivated to come out of that trade. If the basis payments were to flip and I were to start making payments all of a sudden, I'd be very motivated to get out quite quickly. So that's one thing we can look at. Probably if the futures price went down far enough further, then I might think about coming out early as well, because then I'd be realizing a short-term mark-to-market profit on that futures trade. So there's a few ways that you can think about it. In terms of other indicators, there are lots and lots that you can think about. I'm not really an expert on that side of things, but there are several indicators that are available in the Equinex GUI that you can have a look at. And there's a lot of material available on how those are useful in your crypto trading strategies as well that you'll be able to find on the internet. Over to Kieran. Will there be plans to have dated futures moving up before 2 to 3 months if there is demand? Yes, certainly there will be. We're already thinking. So for the moment, we only have dated futures on Bitcoin. The next thing that will be coming will be corresponding Bitcoin, Ethereum dated futures. So the first 3 and 6 month futures on Ethereum. But after that, we're really, really eager to extend our curve out a little bit further. So maybe have some 9 months or some 12 months futures. It is a little bit demand led. So if we see a lot of demand for those, then we'll obviously accelerate that. So please send us your feedback. And it's great to hear that you're interested in that as well, because you can get some really interesting opportunities when you have all 4 of those futures for both those big coins to trade, both calendar spreads on the Bitcoin futures versus Bitcoin futures, but also actually in between the 2 of them. So sometimes there are opportunities to trade one calendar spread long on Bitcoin and one calendar spread, the same calendar spread short on Ethereum, and things like this, if the prices get a little bit out of whack. So we really want to do it. We will be doing it, and we'll let you know when that's ready. Question from Tammy. Is perps or dated futures a better hedging tool given the market volatility? How would a bullish but hedged trade look like? This is interesting. So perps tend to trade spot very closely. So if you're trying to hedge a spot position for a short period of time, perps are a great tool to do that with, because you've protected the value of your spot really, really closely, because you know the perpetuals won't float far away from spot. On the other hand, over a longer term period, perps maybe aren't so great because they have these uncertain basis payments. We know roughly what it might be at the next 8 hour period, but we don't have any idea what it's going to be in 2 days' time even, let alone a week or a month. So although we've protected our short-term portfolio price, over the longer term, we have these uncertain cash payments, which could be positive or could be negative. So maybe it's less ideal. On the other hand, if you use dated futures, oh, have I lost sound? I'm just seeing some messages saying I've lost sound. Do people hear me now? Oh, great. Okay. Sound is back. So in terms of hedging over a longer term period, well, this is where dated futures come into their own. If you're trying to hedge until March the 25th, exactly the instrument that you want to use is a dated future going out to March the 25th. If you want to hedge until June, you need to use a June dated future to hedge that position. So it really comes down to your time horizon. Perps are great for very short-term hedging. Dated futures are great for longer-term hedging. And how would a bullish but hedged trade look like? This is interesting, actually. Dated futures tend to be much more sensitive to spot prices than perpetuals. So if you wanted to form a bullish trade, one thing you might think about doing is going long a dated future and short a perpetual, which is exactly the opposite demonstration. So then you would tend to see that if spot price goes up quite dramatically, the futures prices will rise much faster than the perpetuals prices, and you'll win more on your long than you will lose on your perpetuals leg. What you probably also see in that situation is that the perpetuals would start paying out to the shorts because the price is going up rapidly. And we've said you're short the perpetual. So both of those legs would perform well for you in that situation. Although you'd actually have some unrealized loss on the short perpetual position, that would be more than compensated for by the profit on the long futures position. And on top of that, you'd probably be receiving some positive basis payments from that perpetual. So that would work really nicely in a rising market. Of course, it wouldn't work so well in a falling market. You'd still be hedged from the overall Bitcoin move, but you'd probably see the futures price go down a little bit faster than the perp, and you'd probably have to be making payments on your perpetual position as well. It would be relatively hedged against the price of Bitcoin, but you'd still profit from a rising market and fall from a falling market. I'm being told there's time for about 2 more questions, so let me just rush up. Sorry, I've just seen all these messages about the sound. Those only appeared to be recently. Claire has been testing this strategy for weeks, works pretty well. Really glad to hear. Which feature would you like to see on the exchange, which is quite rare in the industry? This is a really, really fun question. We're looking at a lot of different things on the exchange. One of the things that I'm quite excited by is adding some sound to our platform. So we have some traders who are very active and they're trading very frequently, but at the moment they have to keep their eyes on the platform all the time because you have to get all of your information from the order book, from your positions, from the chart. We would like to add some sounds to it so that maybe you have a little, you've got your order in the book and maybe it's getting filled up gradually. Maybe there's a little laser beam sound when a little bit of it fills up and you get a partial fill so that you have these audio visual cues about what's going on and you don't have to have your eyes on the platform all the time. Maybe if you have two screens, that means you could even be doing something else at the same time and just turn your head back when something happens there. So watch this space. This is something that might be coming soon, and I think it's novel to crypto. I'm aware that some traditional brokerage shops provide this for CFDs and things, but I've not ever seen this in the crypto space just yet. So that's something I'm quite excited about. And last one, then I'll answer Kieran's question. Do traders here use forward curves for these trades? The answer is absolutely yes. I think there's quite a good opportunity right now on our March versus our June futures. If you're really brave, you can also have a look at cross-exchange curve trades. So you could look at trading, for example, the March versus the June futures contract on Equinix against the March versus June futures contract on another exchange if they're trading with a bit of a discrepancy between them. And right now, I think they are. So that's something that you really might want to have a look into. Great opportunities all over the place. And actually, particularly during volatile markets, you tend to see some really, really interesting curve and yield opportunities. If you're using leverage, be careful. Please sign up to Equinix, have a look at the basis spot, do some scouting, and maybe have a go as well. But experiment in small size first. Create a sub account, which you can do on Equinix, to isolate any positions so that they won't affect your main account, and trade in small size if you're going to experiment with these things. It's been a really great evening to be presenting to you all. Thanks very much for the good questions and happy trading.